The G7, and specifically Janet Yellen, have proposed capping Russian oil prices. In this video, we'll explain the reason why the West is considering making this move, as well as the mechanics behind it. And furthermore, we'll look at the options that Russia has to combat these price controls. And finally, I'll share my concerns on how this plan could backfire against the West. On the 5th of December, the EU's ban on Russian seaborne oil imports will go into effect, which will drive up world oil prices because prior to the invasion, Russia was the largest supplier of crude oil to Europe, supplying roughly 1/3 of their needs. Now that figure is closer to 1/5. But still, as of August, Europe was still importing 1.7 million barrels per day from Russia, which is quite a large amount. And after December 5th, they'll have to find new sources. However, these producers will have less supply to go around to their other customers. Experts are predicting that we could see prices around $100 per barrel after this move. So this means that the world is going to be paying more for oil. But meanwhile, Russia's marginal profit for the barrels that they are selling is going up. So that doesn't sound good. But that's where the cap comes in, to keep global prices low while limiting Russian profits. That sounds better, right? If they can force Russia to sell at a low price, since Russia will then have the cheapest oil on the block, there should be a big line knocking at the door to buy this discounted oil. And since Russia's marginal profit for a barrel of oil has decreased significantly, maybe Russia will even boost their production to keep profits steady, thus stabilizing global supply and keeping overall market prices at the rate they are now. Well, that's the idea at least. But how will the West accomplish this? Let's look at the mechanics behind the cap. Well, the first step is setting a cap price, and talks have indicated that could be somewhere between $50 and $60 per barrel. And the West has the leverage to pull off a move like this because they control many of the ships used for transporting this oil, but more importantly, they control the insurance. For example, to go through the Suez Canal, you need a certain threshold of insurance. Insurance that is typically purchased in the United Kingdom or Germany. I'm sorry, but Chinese, Russian, and Indian insurance does not work here. They will then require the insurers to enforce these caps as a prerequisite to obtain insurance. And then on top of that, it requires that other nations play ball. For example, a country like China, who shares a border with Russia and even has a pipeline with Russia, this will be tougher to enforce. But the theory here is that other nations will be incentivized to get the lowest price possible, thus would lead to cooperation. But as these caps create a segmentation between the world market oil price and the Russian oil price, pressures could build to abandon these caps. I'll explain more about this later, but let's shift the conversation to the Russian perspective, and we'll look at the options they have as these price caps are imposed. If Russia is primarily thinking about profits in the short term, there's potential that they could play right into the West's hand and continue selling at a low price. First, it's important to consider Russia's break-even oil price, which is much higher than many nations across the world. It's estimated at somewhere between $30 to $40 per barrel, which could be compared to $10 to some Middle Eastern countries. This means that Russia's oil industry does not perform well in times of low prices. And in fact, during the pandemic, we saw the cost of production in Russia exceed the global market price. Overall, you can draw the conclusion that Russia will be quite sensitive to these price caps. But to make up for these lost profits, Russia could ramp up oil production in order to sell more, which would put more oil into the market, thus lowering the overall price. But the West is taking a major gamble here that Russia will keep up production and keep selling. But do you think Putin will play right into the West's hand? Perhaps a more likely scenario is that they continue trading with only non-participating nations, like for example China. Prior to the invasion, China sourced 30% of their oil from Russia. Now that figure is closer to 40%. And I expect this trend to continue to grow and China to remain a big buyer of Russian oil. And as these potential supply shocks hit, Russia can continue selling to China at these elevated levels. But then there's another option for Russia, which would be to stop selling altogether. However, this would also come with huge drawbacks, as oil is a major source of income for Russia. And then there's the cost of inaction, because even if you're not selling, it's still cheaper to continue drilling as opposed to closing and reopening a site. But here's how this move could come back and bite the West. As Russia is the world's second largest producer of oil, producing 10.5 million barrels per day, which accounts for 12% of the global oil supply. If Russia was all of a sudden to stop selling oil, this would dry up the world's supply, driving prices upwards. Barclays estimated that if Russian seaborne exports were disrupted, this could send the price of oil to over $200 per barrel. This would certainly put pressure on the cap to break. Meanwhile, the rest of the world is stuck paying record high oil prices. Russia could re-enter the market and be able to charge an arm and a leg. And it's still conceivable to think that Russia doesn't even have to stop selling altogether for the market to be disrupted enough to break the cap. But on top of all of this, there's still one important variable that we haven't discussed, and that's the kings of the oil market. Recently, we saw OPEC announce a significant decrease of 2 million barrels per day of production, a move that was viewed as hostile by Washington and couldn't have come at a worse time. It's my opinion that OPEC is dismayed from the attempt the West has made to manipulate the oil markets. A move like this would establish a precedent, and OPEC members could fear that a similar move could be made against them in the future. For the integrity of the organization, it's important they stand up for another member, regardless of who it is. Nevertheless, this has made the oil markets even more fragile, and as Europe cuts off from Russian oil and imposes caps, it's possible that we could see record high oil prices in the near future. If you enjoyed this video, please consider subscribing. Future topics include India, Iran, and more from the war in Ukraine. Thank you for watching.